So my goal here is to talk about some financial statement analysis. This presentation is focused on that. There's lots to say, and the book is quite, substantial in that regard as well. So as always, my remarks here are probably going to be pretty lengthy, but they're designed to at least provide some efficiency, give you some insight into things that are maybe the most important of all to gather or garner from the text. Um, we're really talking about, and we looked through some financial statements in an earlier presentation, discussed, um, the income statements, balance sheets. That's usually the order they're in annual reports, right? Some of the, some reminders of why they flow the way that they do, and information to take from them and such. So a natural thing to do is to consider, well, what can I do with these things? Like, all right, that's interesting information to a point, but is it just going to collect dust on the virtual bookshelf? Am I going to learn something from this? And you might learn something from financial statement analysis as an investor, where you're considering which company's stock, for example, most popular example, to buy and which ones to avoid or even sell if you're already an owner. Right? Or you might be looking at this sort of thing from an internal quality control, financial management sort of point of view, where you're the in-house financial folks and you think, right, what's concerning here, right? Or what's looking great here? Where's our advantages and that sort of thing. So, you know, what is the goal of actually looking at all of these numbers? Right? And in particular, say I'm not an accountant. So I'm not looking at them just to like calculate a tax bill or figure out the best way to save on tax. I'm looking at them to garner some information for kind of analysis or either investment purposes or internal quality control types of things. So you're looking, right, to kind of compare performances. And usually, we got a slide coming up here in just a minute. It says comparison norms, right? You have to just look at a number and say, oh, we had a net income of $17 million. Well, that doesn't do you much good without some frame of reference, right? So the most common things to do are to consider um, where you started or where you were last period. That's the reason when we were doing all sorts of examples um, last time when we were doing financial statement presentation, you saw that the real world version, normally when you're looking at, say, an assets part of a balance sheet, you're actually looking at the assets this year, but also the year before, and the year before that, and the year before that, and the year before that. It allows you to see the trend, right? Another thing to keep in mind, and talked about this a good bit in our financial statements presentation as well, was if you're like me and you're a finance person, a really big goal, a really interesting thing for me is I'm wondering what kind of cash I might be able to generate from my firm, because cash flow is the real reason for value to a finance person, right? Why do I actually own the share of Apple? Well, I own the share of Apple with the hopes that it's going to pay me cash in the future, the future free cash flows, right? Well, what are some of the best ways to get a feel for that information? From taking it from your financial statements, right? So if you're like me and you're big into this world of, let me open a little example here. If you're like me and you're big into this world that, hey, my best estimate of stock price is all the free cash flows that I can generate in the future, right? Then knowing your financial statements well and understanding how they flow, and you also have to add the cash that you currently have today. And you divide all that by the number of shares. That's your stock price per share. Right? Well, the better you understand your pieces of your financial statements, the better you, right, can project free cash flows. Right? We say here benchmarks, right? The other one, besides just looking at the trend, which again you see in your financial statements, it's the same, of course, with the liabilities and equity, the traditional right-hand side of the statement, as well as the assets. Not just how you've changed over time, it's also really common to look at other similar firms. Now, just describing or defining your peer group, right, is challenging, right? Usually to define your peers, right, sometimes you know it when you see it. It's like, tends to be like a Coke Pepsi sort of thing where it's kind of obvious, right? But other times it's a combination of industry and size, right? You probably don't want to look at companies that are 100 times your size in the same industry because that would tend to put them in a position where they're making different sorts of decisions for different reasons than we are, nor would you want to look at ones that are 1% of our size. And so it's kind of a combination. And sometimes if there's no one that's super close to our size, we might be willing to compromise a little bit on the industry, right? And rather than only looking at someone that's specifically in exactly the same line that we are, we might kind of do something a little bit more holistic, if you will. So those are possibilities too, right? But there's no doubt, right, that you're by far most two common kinds of financial analysis are to look at either the trend analysis, which is the firm compared to itself over time, right? Trend just means time. Right? That's one method, and then again, comparing to your peers with a, let's say, the challenge can be the definition of peers there. Comparing those things are probably the biggest two of all. Now, what should we compare either to ourselves or to our peers, right? Should I just compare total assets over time? Should I compare profit, net income over time? That's, you can. There are some times where we do that sort of thing and keep an eye on the dollar amounts of those sorts of things. But what's more typical is to compare ratios over time. Ratios standardize information in some way, shape, or form so that if, for example, your company doubles in size over 5 years, you wouldn't think the same thing about if your profit stayed the same, right, from year 0 to year 5, while the company doubled in asset size, then that could actually be a concern, right? Whereas if if you just look at the profit itself, it's about the same. That probably isn't that interesting or surprising. Yes, but if your profits stayed the same while your firm has gotten bigger, that's the kind of thing where you would sort of worry. So the idea of a ratio, right, is it helps standardize financial statement information. Now, whether you want to write that down or not, I'm not sure that it matters a huge amount, but I'd say ratios standardize financial statement information because it gives you a comparison of something with a basis. Ta-da. Okay. So oftentimes you'll see as we go through a lot of ratios, you'll see that, for example, you might be using total equity or total assets or total sales as the denominator when you do a lot of ratios because it compares some numerator metric to how big the company is. That's a very common thing to standardize by. Okay. Ultimately, why are ratios useful? Well, the book's kind of way of saying this is, again, the standardized numbers, and it facilitates comparisons, right? That's kind of review. We already mentioned that the last few slides. Ratios are a good tool to use when you're looking to compare both to your peers or to yourself over time. They bring about weaknesses and strengths when you do that. I kind of like as a sort of an addendum to that sort of thing. My big thing about ratios, right, is that they allow you to a lot of efficiency. Oops. Ratios provide information efficiency. And if you're looking to say that another way, a lot of bang for the buck, or a bang for the buck. Right? In this case, it's more like a bang for how much work you're doing, right? Reading financial statements, you saw some previously. I showed you a really old McDonald's one, annual report. That's a lot of reading, right? And some human nature get a little bit lazy and such. A lot of reading, a lot of reading. Sometimes you can get a lot of information quickly if you can use a ratio to do some comparison. So a really nice thing about ratios is you could say something like, oh, I have a current ratio of 1.7, or I have a profit margin of 6%. And it tells the reader, right, and potentially your internal colleagues, right, or your investment advisees or whomever, it tells people something quickly, especially when you compare it to yourself over time or to your peers about how good or bad I'm doing. So again, highlighting strengths and weaknesses sort of thing. And you can get a lot of information quickly if you're using the ratio to do so. But here's the caveat with this that I always tell people to keep in mind, right? So this is a lot of bang for your buck, but be careful, right? You need to be honest with yourself when you're using financial ratios, even if you're using them in something like a portfolio paper that I have you write, that's, you know, it's required to use your ratios. But a ratio is not a full substitute for knowing the 10K, the financial statements of the firm, etc. Sometimes there's more than one way to get, say, a 6% profit margin. Maybe you got a 6% profit margin because you had some, obscenely high prices that customers were willing to pay because of, some run on product, but it's not going to hold in the future. And other times, 6% is just a typical profit margin for you. So different ratios can come about with an underlying different story. And even though it's very typical to compute the ratios, because it's pretty quick to compute most of these, and to compare ourselves, right, to our firm or over time, right, even though those things are normal, you want to be careful doing it, because you are indeed taking a shortcut if you're not really digesting the detail of all of your financial statements, kind of thing. It's somewhat common to look at your financial statements in a common size framework, right? So the thing about this is, if you're willing to say, again, for example, in like a Coke Pepsi world, if you're comfortable that your peer, for example, is close enough to you in terms of size where you largely do the same things and have the same motives and stuff like that, rather than looking at dollar amounts like, hey, they had $39 million in profit and we only had 16. Well, yeah, they're also twice as big as we are. Oh, well, in that case, it's not so weird. Well, one starting point to really facilitate that kind of talk is to put all of your balance sheet items in common size, which is to say, use, for example, your total asset amount as the baseline, and then everything on your balance sheet, say, is reflected to be some percentage of total assets. And so you're never necessarily looking at any dollar amounts at all with a common size framework, right? You're doing it with a feel for, oh, my inventory is 11% of my total assets. Right? It works the same with my debt, too. My debt is 17% of my total assets. My current accounts payable are 3% of my total assets, whatever. Right? With income, and we do that because the total assets, the reason for the basis, total assets is typically the largest single number you would see on a balance sheet, yes? So having that serve as the baseline keeps everything kind of less than 100%, really. Usually, there's always some weird exceptions, too. Income statement, that same idea applies, but it works with sales, which is, of course, at the very top of your income statement, which you typically know number bigger on an income statement than your sales. And so if you use that as the baseline, oh, we had $100 million in sales, then if you have, 13 million of SG&A expense, then it shows up as 13% on your common size income statement, that sort of thing, right? So, right, if you're looking at this example, say then this company has nearly, not, it's probably not, it's gone up. How much do you figure? Gone up about 50% in size in the last year from year one to year two, right? So in that case, right, your total assets, 48,671,000. That's the basis for all of these. So when you say, oh, my current assets, just to keep an example here in bold, are 17.5 million. Well, 17.5 of 4867. Right? So to me, in my mind, I'm putting 17.55 over 48.67, and I'm getting a percentage, if you will, of 36% for current assets. Do the same number here, and yeah, your current assets dollar-wise went up from year one to year two, from 17.5 to 21.6, or 17.6 to 21.6. But as a percentage of total assets, now you're only sitting on 21 million out of 73 million ish. So that's 29% current assets. So while your current assets themselves went up from year one to year two, the percentage of which they take the total pie, that is your total asset, has gone down. And similarly with all sorts of other piecemeal calculations there in your framework, right? There's your right-hand side, if you will, of your balance sheet, yes? So in this case, right, looking at the bottom here, for example, oh, actually, my bad, I misspoke. In this case, I didn't even give you dollar amounts of liabilities. I just immediately reflected, yes, the total, the common size income statements. I was flustered. Sorry, folks. I got flustered by my own mistake there. I gave you, this is the right-hand side of your common size balance sheet. So these are still all shown as percentages of those total assets from two slides before. So if you wanted to work backwards, you could easily do that. And knowing that the assets were 48 million in year one and 72 million in year two, and these are all percentages of those totals, you can easily work around to figure those out. But for example, in this case, you've actually seen your liabilities, they went up from year one to year two, right? But not only did they go up in dollar terms, they also went up in standardized terms. They also went up as a percentage of your total assets. Right? So the comparison can be seen quite directly there. Let me take a peek. Right? And then there's your income statement, right? And the income this isn't as dramatic a change. It's not a 50% increase in sales or revenue from year one to two. It's only about what would you figure, about a 20% increase in revenue from year one to year two. But now the baseline is the sales. So for year one, the baseline on all of these things is 30,990,000. For year two, it's 35,119,000. So your cost of goods sold stayed pretty consistent, but one year to the next went from 35.7 to 36.1. But those numbers are both divided by their respective sales just above them each to come up with those common size percentage numbers that you're seeing in the final two columns. This kind of gives you an eye really quickly for how you're doing in terms of certain percentages and in certain margins. For example, when I look at this sort of thing, right, I'm sort of interested in that, right, now my net income, for example, went up a lot. I mean, that's like a 50% increase in net income. And that's after accounting for how many sales I did, right? I went from having a 22%, right, net income over revenue to a 34% net income divided by revenue. And again, I think right away, wow, that's really impressive, sort of thing. Well, it is, but when you see the full financial statement, you kind of get a little bit more careful about that sort of thing. For example, what's with this total other income there, right? That's a huge difference between these 2 years. Right? And if you peel it back even more, you see that $5 million-ish here is almost exactly the difference between these two. So if I'm thinking of this in an analysis sort of way, this is an example where you want to be careful with your shortcuts. Yeah, the shortcut tells you, oh, my net income is increasing, has increased a lot as a percentage of my sales, and that's good news. From year one to year two, I'm much more profitable. I'm more efficient about getting net income out of total sales. But but when I take a step back and look at more detail, beyond just the ratios, or in this case, just the common size info, I start to wonder, well, was that a one-time thing? Is total other income some sort of special event, or is that repeatable kind of thing? Okay, it's pretty common to categorize ratios under different umbrellas. Like there's different ratio tools that help me consider my firm's liquidity position, i.e., how am I doing in terms of cash management? Am I in a good spot to pay bills on time, to make payroll on time when those current type liabilities are coming due, like accrued wages or accounts payable to vendors, et cetera, et cetera? Am I sitting on the right kind of cash balance, right? And I don't only include cash in liquidity measures, but I include other short-term assets. What kind of liquidity position am I in? Am I in a hunky-dory shape to meet my short-term obligations that are coming soon? Debt management, more of a or less of an immediate sort of thing, but what kind of a position am I in terms of debt? And these are examples, by the way, liquidity and now debt management is particularly, where industries are very different one to the next. So that's why peer comparison can be really important. Having 80 or 90% debt, if you were in, say, the grocery business, would be kind of disturbing, right? But if you had 80 or 90% debt in banking, you would be a quote unquote well capitalized bank sort of thing, because that's just a very different world in terms of how those operations of those businesses run. Right. So, okay, I digress a little bit. Back to that. This is less immediate debt management or leverage, but it gives you a feel for what kind of risk level do I have in terms of debt. And there's other kinds of risk besides just defaulting on it. Right? But if you have somewhat large debt, then the chances of something going wrong and the catastrophic impact is worse with more debt. Well, what's quote unquote more debt? Varies by industry, and again, we can compare ourselves to our recent years over time to get a feel for that trend sort of thing too, but those are just things to keep in mind. Right? Asset management, the other side of that coin, right? You have assets at your disposal by which to generate sales and hopefully thereby profits. And like we talked about last chapter, if you're an investor, hopefully those profits, accounting profits, eventually translate to cash flow, right? But how are you doing in terms of using your tools, your assets to generate sales? And then, of course, those sales, right, will eventually, hopefully, will translate to profitability. So segueing there to the next one, right? How are you doing in terms of actually realizing accounting profit relative to items on your statements? And again, this will give us, when you're looking at this in a common size framework, it's going to give you a feel for how you're doing in terms of those things after already taking scale into account. The last of these 5 categories here is market value. To me, as a finance person, those things are kind of special. And market value has a little bit different of a flavor than the other ratio categories that we're talking about right here. Because while these other 4 categories, starting on slide 11 and going into 12, are usually calculatable just by looking at the financial statements themselves. Oh, my current ratio is my current assets divided by my current liabilities. Yeah, most of the other 4 areas you can calculate with just your financial statements. With market value, you usually need to know other information too, in particular what the stock is worth, right? Out there on the stock market today, what does it trade for? Right? And as we've talked about in the past, there's a difference between the book value of a stock, where on the books, the value of the equity might be $80 billion. Sure, it's a lot, and we have 1 billion shares, so they're worth $80 each in terms of our accounting or book value. Right? But your market value is a very different thing that takes future expected cash flows into account. And so when it comes time to do market value based ratios, we usually need additional information beyond just the accounting stuff that you see on your statements. A few examples of liquidity measures, and remember, right, you have access to materials here. It's not like you don't need you don't need to memorize necessarily all these things when you're thinking about like grades and stuff in the course. Right? You don't have to necessarily have these sorts of things committed to memory via flashcards or things like that. But just by working with them some, you're probably going to very quickly get to this. All of these use current liabilities as your denominator. These liquidity measures do to standardize or to kind of consider or standardize by. Right, the current liabilities in the denominator basically reflect, well, what kind of bills do I have coming due soon? Right? Do I have these accrued wages I have to pay employees? I have accounts payable due to vendors. I might have income taxes coming shortly due, right, that are a current liability. Do I have the funds by which to pay those things? So a really natural thing to do when you're dealing with liquidity measures is take a first glance and see if they're greater than 1. Because if they're bigger than 1, the numerator is greater than the denominator. Right? Now, eventually, you have to actually pay for your current liabilities using cash, right? If they're actually, fully, if the cash is typically due for these things, you have to pay for them in cash. So you might say this is the strictest and toughest metric to meet is your cash ratio. Sometimes you have other assets that can quickly be converted to cash if you have things like short-term investments and such, which you could really sell them and get their cash value off very quickly. So sometimes you want to include other current assets besides cash. You don't want to be too hard on yourself and only think of cash as the asset available with to pay bills. On the flip side, you probably don't want to include every kind of quote-unquote current asset as on your side in terms of bill paying. Inventory being the biggest example of all. Your inventory on your balance sheet is just booked at the value of the parts that were put to into assembling it. But you might be selling your finished product, your inventory, for 3 times, 5 times, 10 times the actual pieces that went into its assembly. This is the kind of thing that's easiest to think about in like a manufacturing setting, of course, right? Well, you wouldn't want to take credit for the inventory on your books when you're thinking about the liquidity position of your firm, right? Because the whole point is you don't want to disassemble your inventory and send the parts back to your vendors for refunds. That's what you would have to do if you were including the inventory value as a current asset in the hopes of paying bills with it. If you want to turn inventory into cash, you'd have to disassemble it, send the pieces back. Well, that's kind of against the grain of what you're trying to do as a business, yes? You're hoping to sell that inventory for cash, much more cash later. Right, so a really typical liquidity measure is the quick ratio or acid test that excludes only inventory when looking at the pieces that go together in this calculation. So that's kind of in between. It's not as generous as the current ratio that includes all current assets at their book values when computing, but it's also not as strict as the cash ratio, which only lets you use cash and compares that to bills coming due, if you will. Right? In general, higher values for these things are typically preferable. Like higher values suggest more liquidity. Right? So if I had an absolute gun to my head, right, I would say, if they said, hey, do you want your liquidity ratios at the firm? Forgive me while I erase here. If you do want your firm's liquidity ratios, right, to be higher or lower, if they said, oh, liquidity ratios, do I prefer higher, lower? If I had to pick, I'd pick higher, right? Because I'm in dire straits if it's too low. I don't have the cash or near cash available to pay bills, and that can grind my operations to a halt. I will lose my credit with vendors, all those sorts of things, nasty, right? But it's not completely true that higher is just strictly better. I mean, higher being strictly better makes it sound like, oh, well, forget this current ratio of 1.1. Let's get it to 1.7. Ah, the hell with that. How about 2? How about 5? How about 20? Well, the reality is, at some point, it's just too much. So we have a little bit of Goldilocks situation here where, yeah, higher is better, but you probably don't want it too high or too low. So I mean, I think higher is preferable, but not higher doesn't strictly mean, oh, better and better and better as it gets higher and higher and higher. You don't want to sit on too much cash. At some point, you either want to pay the cash back to your investors in the form of dividends, right? Or you want to do something with it. Right? But just sitting on cash that earns no interest or very little return as some kind of short-term investment is problematic. You're wasting an opportunity. The investors, the owners of the company, if you're not going to do anything with it, if you're just going to hold it in a bank account on the company's level, well, give it back to them. They can go find another investment, that does something. They can buy shares of a different company somewhere. Right? You don't want to just sit on cash to sit on cash or hoard cash, and that's just one extreme example of how, yeah, it might be better or preferable if you had to choose to be a little on the high side of liquidity ratio. It certainly would be safer, but again, that's not the same thing as saying that higher is better, higher is better, higher is better. Right? And I think you can go back here to your balance sheet and get a current ratio or cash ratio of, right, cash and equivalents 8.37, right, divided by 72.921, right? And when you do that sort of thing, right, you end up with, right, 0.45 kind of thing. Oh, I'm sorry, I should be using current liabilities, my bad. Sorry, misspeaking there. So I guess for your cash ratios, you want your cash. You can do them all as percents because all of the liability and equity numbers here on the next slide, those are all in percentages, yes, but they're all based on total assets as the baseline because assets equals liabilities plus equity. So long story short, if you wanted to get the current ratio just on what we had right now, right, you could do cash 11.49% divided by current liability is 25.38%, and that would get you up about your 0.45 sort of thing. You can do total current assets 29.59 over current liabilities 25.38, right? And 29 over 25 is what, about 1.2-ish, 1.17-ish. Yep, there it is. So you can use the raw dollar amounts, the more traditional financial statements, by which to calculate these ratios and say, and again, you don't need to memorize the formulas, you'd have access to them, but you ought to be able to understand what they're telling us. That's much more important at our level. Right? You can use the raw dollar amounts or you can use the percentages. As long as you're correctly calculating the common size values, it works just fine to use the calculations when you're doing when you're doing the ratio calculations themselves too. Some debt management ratios. Right? In this world, right, we're kind of getting a feel for in the top two, total debt ratio, debt to equity ratio. You're getting a feeling for how much debt you have, and again, especially when you compare to yourself over time or to your peers. What you really tend to have your antenna up for here is, am I taking on a lot more borrowing than other people do, other firms like me? Or have I taken it up or down a lot in the recent years? With the thought being that, hey, at some point, interest expense might become prohibitive. Or, hey, at some point, if I'm in a more dangerous business, for example, if we were to have a downturn, am I going to be in decent shape to repay my debts? Because that's another example of something that can become a crippling or even fatal management flaw sort of thing. So when it comes to a debt ratio, debt to equity ratio, right, and then even total assets, total equity is called the equity multiplier. It's got a weird name to it, right, because it actually has the assets which are larger in the numerator. In this case, as your equity goes down, right, that's in the denominator, meaning you take on more debt and less equity, this thing goes up. So your equity multiplier, I always thought was a weird name for this. I always thought debt multiplier might almost be better because this equity multiplier gets larger when your equity gets lower. As your equity gets lower, that means you're taking on more debt instead. Right? and this quotient gets larger and larger. To me, if I had to pick, and of course because of the way that the debt ratio is defined, it works out to be the same as 1/1 minus the debt ratio. To me, when I'm dealing with debt management ratios, again, as a default thing, if I absolutely had to pick, I would probably prefer lower, right? Because lower is less risky. But like always, a ratio just tells a little bit of a story. It's not, it's, there's, sometimes there's extremes or there's weird things about this that actually make this thing a little bit, you gotta be a little bit more careful than to just say, well, lower debt is better. It's not always better. We'll talk more about other pieces in our class here, but debt can sometimes be a cheaper way to finance the company than equity. People always think of debt as risky, and of course it's riskier in that you have a chance of defaulting on the debt and therefore going bankrupt. But if you take on a lot of equity and you don't use any debt, well, then you're sharing your profitability and your cash flows that you're going to eventually generate in the future. You're sharing your profitability with more and more people as you issue more shares of stock. And if that's something that feels dangerous to you that you don't want to do, then you might alternatively finance with debt. Debt also has some tax advantages over equity. We talked about that a little bit already as well. Interest payments on debt are tax deductible, which is to say, if I have $4 million of interest expense, but I'm in the 25% tax bracket, I might pay $4 million of interest expense, but I get to deduct that before I calculate my tax bill. I effectively save $1 million in tax. So my $4 million sticker price, if you will, of debt, it's really only $3 million that it costs me because I get to pay less to the government and thereby have some savings. Now, good or bad, again, depends on the situation. And in general, I'd prefer less debt to more because of the flexibility, the risk of bankruptcy that goes with higher debt, etc. But it is not strictly true to say, well, let's get the debt down to nothing. Let's make it as low as possible. Get my debt lower and lower and lower. Get it to zero. No debt at all. Blah, 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 blah. Right? With a corporation and running a company, that's probably not ideal in some cases. By the way, reminder here, we're not talking about household finance, right? If you're talking about personal finance, I would say it basically is the same that debt is bad, right? You don't want to have owe on anything. And the sooner you pay off every debt you got, including your mortgage, the more prosperous, better life you're going to have. But I'm not talking about debt for consumption here. We're talking in this chapter about debt used to produce things at a company that you then go and sell for hopefully an even bigger profit. And in this case, keep more of that profit amongst the fewer owners that you have when you have less equity. These are some other debt management ratios, the times interest earned. This effectively tells you, right, how big your interest expense is. Now, when I say debt management ratios and I say lower is less riskier, I'm really talking here about total debt, right, debt to equity, and equity multiplier. Right. Here, I wouldn't say that lower is better for times interest earned, right? And if interest goes up and EBIT goes down, that makes it lower. Well, that's not a good thing. The times interest earned effectively tells you, hey, your operating income, your EBIT, how many times over can you cover your interest expense by generating it? In this case, you'd probably want a TIE to actually be on the higher side. Right? Cash coverage ratio defines the same thing, but since depreciation is not a cash expense, it also gives you credit back for depreciation expense before calculating this number. So cash coverage ratio is usually even higher than interest. It's trying to give you an idea of how much cash you're generating with your operations that you therefore could meet your debt expense, the service of the debt, the interest payments. And you see another one here, our EBITDA coverage. EBITDA is pronounced EBITDA, even though it's like EBITDA kind of thing, right? And EBITDA or EBITDA is even higher up on your income statements. It's basically, right, that calculation, right, of gross profit. Right? Not always, but say that can be defined a little bit different some places. But if I was ever grading it for you, I would be clearer. What else? What else? What else? So you say usually now in this case, say in many cases a larger debt ratio means more leverage. Well, that's for the first few. Again, so that comment about larger debt being riskier and therefore probably preferably lower, that's the case for our first slide, for slide 16. Right? But as you see here, the ability of the firm to meet your interest payments, right? These larger times ratios, the bigger these are, right, the safer you are in terms of having near liquidity available by which to pay bills. Trying to think what else to bug you guys about with. The right. And the answer is, yeah, it's yet again kind of a thing with ratios. Some like these are often, um, you know, Goldilocks type situations where you might prefer higher or lower, but you probably don't want them to get super extreme in one form or fashion because you can always you can almost always come up with some counterfactual argument of why you wouldn't want to take a ratio to a super extreme. For example, even a times interest earned ratio, which we say here on the slides, yeah, bigger is better. That's true, right? But if you have a super big it's bigger is certainly safer because you're in a better position to cover your interest payments. But it's also true that if your times interest earned ratio is really huge, maybe you're not paying any interest at all, and so maybe you're not availing yourself to the advantages, the tax advantages in particular, and lower cost of debt um, that come with using debt as a financing scheme. Right? If you have an all equity or near all equity firm, you're probably going to end up paying a higher cost of equity than you do a cost of debt, and maybe that's not necessarily the best decision. So say we'll talk more about cost of capital stuff in later chapters, but that's just one example where again ratios, you want to be careful about the full story kind of thing. Right? So it says here, well, how much debt do we have? Well, the various debt ratios measured, all kind of give you different frameworks for spitting out the same thing. Right? Your debt to your debt ratio, so we're going back here to slide 16. Right? Your total debt divided by your total assets. And again, you can do this with like a common size framework. Right? If your total debt is about, I don't know, we said 49% or 58%, or I believe in this example here, they're talking about an example where it is, 40%, right? They just kind of made that one up out of the blue. That doesn't go back, I don't believe, to our initial financial statements. That happens here, right? If, for example, you just had a debt ratio of 40%, that means you got 40% debt, 60% equity. Well, if you got 40%, 60 debt and equity, then that also determines, again, by definition, right, your debt to equity ratio, right, because it's debt to equity. So 0.4 over 0.6 is 2/3, right, or 0.667. It also tells you your equity multiplier. That's your assets over your equity. And so, again, the bigger that gets, the riskier tends to be, right? Because if you had a 20% equity and an 80% debt, that number would be 5. As it is, it's only 1 2/3 sort of thing. All right, and there's, the baseline calculations for all of the debt ratios based on our financials up above. Just if you're looking to like see, can I plug these values in and get the correct calculations for these things, you can use here in your financial statements back in slides 7, 8, 9, 10 to generate those answers. And moving into asset management ratios. Right? These tend to be even a little more ambiguous in terms of, well, what's better, higher or lower? And again, there's never a complete right answer to that sort of thing. You might have a thumb on the scale, right? Where, oh, I'd like my sales to be relatively high. I like to generate a lot of sales. So, sales inventory turnover ratio higher is better, right? Well, say that's true to a point, but what about something like, Shark Tank, the TV show they always had? A lot of times you'd see people come on the show and say stuff like, "Well, I didn't have enough inventory, and so nobody wanted to do business with me because I'm making these out of my garage, and I don't have the inventory." I said, "Well, that's a problem, right? That's one way to get a a high inventory turnover ratio, that you don't have any inventory available." But it's practically an enormous problem, because if you don't have enough inventory available, you might not be able to generate your next batch of sales, that sort of thing. So if I had to pick with most of these asset management ratios, I guess higher is a little better, but that's not saying. Again, you can come up with counterfactuals and issues to that sort of thing really quickly. Okay. Um, daily sales and inventory, right? That's your inventory over your cost of goods sold over 365. That just tells you effectively how long does your typical widget stay as inventory before it's sold. Right? So 6.75 means it takes about a week, effectively, once you produce inventory to sell it. It's based again on the stockpile of how much inventory you currently have. So in some cases here, right now we're kind of mixing and matching balance sheet and income statement information. Right? Now you've got cost of goods sold from your income statement. You also have inventory from your balance sheet, sales from your income statement, inventory from your balance sheet. As you say, this slide here, 22, we're talking mostly about inventory type metrics. Your inventory turnover just measures how many times in a year would I be able to cycle through my entire inventory, kind of thing. It takes me this much to put them together, my cost of goods sold, 10 million, and I've got 2.5 million available. Well, that means it takes four times 10 over 2.5 is 4. That means approximately 4 times a year you have the expenses to pay for the entire new set of inventory. There's some others too. And say again, full treatment of these in your book and such, and even more beyond just these. Right? Managing your sales versus receivables. Right? This time your receivable turnover ratio tells me how long does it take for me to collect, if you will, right, on my credit sales. Your daily sales outstanding of receivables works similarly, but what it does, receivables turnover tells you how many times a year you can effectively collect on your grand total receivable. If I have a sales of 10 million and a receivables of 4 million, right? An annual sales of 10 million and a receivables of 4 million, it tells me that it takes me like 2.5 times a year I would get paid in full for my receivables that I have at any point in time. So that equates to what, about 4 or 5 months that it takes for me to collect my receivables on average. When you do it out this way with the daily sales in receivables, you actually come up with an answer in days. Right? Oh, it takes me this long in days to collect on my typical credit sales. It turns from accounts receivable to cash this quickly. Really similar when it comes to your payables. It's just that instead of dealing, right, with your sales and receivables, now dealing with cost of goods sold and your accounts payable. Right? So again, it's telling you, well, how many times a year, right? The top one, payables turnover, how many times a year would I be able to, would I end up effectively paying off my entire accounts payables balance? Or you flip it with a little bit of 365 days in a year, and you have the daily sales and payable. Your daily sales and payable tells me how long does it take to effectively pay, right, for my typical credit bill sort of thing. A lot of these things too are sometimes like a stew or a chili where you're combining a bunch of different types of payables or types of receivables. You might have a drug company that has lots of different product lines, and the financing structure for some generic that you've cranking out for years and years is different than, say, some state of the art drug that's right, very hard to come by. And yet, if you throw all of your receivables, quote unquote, in one pile, or all of your sales in one pile, you could get some far out results that are kind of too macro. They combine too many different things. That's just yet another example of why you want to be really careful when you're really doing financial statement analysis to recognize, yeah, I'm taking a shortcut here. I'm using a ratio to form an opinion on something. Maybe if I don't do that, maybe if I instead, right, look at the detail in the financial statements, I can get a fuller story. But it takes much more time to read the financial statements, of course, and all the management commentary there too. So it's very human nature in finance to want to run and plug in ratio type things to get a feel for what they mean. Some more, asset management here. This tells you effectively what kind of revenue, sales, do you generate for a firm your size. And there's just a couple different ways of measuring firm size. Fixed assets only considers your property, plant, and equipment type things. Total assets, of course, considers everything. And the idea here, in general, would kind of be still, if I had to guess, bigger is better, right? That higher is better with this sort of thing. But again, you got to be careful with that sort of thing because, yes, I like to have sales. And I think it says a lot that I can generate a lot of sales with only so many assets. It kind of makes you feel good, right? That I can generate that much sales with only these tools, these assets at my disposal. But on the flip side, if you compare yourself to your peers and have a super extremely high asset turnover ratio, well, maybe that means like a lot of your fixed assets have depreciated a lot. Maybe that means you're really overdue for some new equipment. That could be a new expense on the horizon, right, for our firm. So, again, if you get, say, extreme values of ratios in particular, we almost always challenge the view that, yep, higher is better, higher is better, higher is better, or lower is better, lower is better, lower is better. Because there's typically some sort of counter extreme where you can sort of demonstrate, nah, that would be dangerous. Right, so your turnover ratios basically are giving you a feel for how quickly you can, grease the gears for different operational parts of your company. So generally, yeah, higher, preferred sort of thing. There is one exception to all of that, though, which is your daily sales outstanding example here. That says, say, quickly, as sort of a kind of a quick way of thinking about it. Daily sales outstanding effectively measures how quickly can you collect on your credit sales, right? So if you go back to DSO, to daily sales outstanding, effectively this measures, my sales relative to how big my accounts receivable balance is. We don't want to run around having a huge accounts receivable balance. You want to collect. When you're due money from your customers, you want to get paid, right? And so, yeah, here, while most of these higher is better, there's a little bit of a caveat, particularly with daily sales outstanding. But even then, folks, this is just more evidence of, again, of be careful. Ratios are a useful tool. They allow you to learn something and talk quickly for comparison purposes. But on the flip side of that, you can almost always come up with a counterfactual. In this case, daily sales outstanding, what happens if it gets super small? Well, maybe if it's too small, it means you never have any bad debts. You're only offering credit on very strict terms. Maybe you're foregoing some sales. Everyone pays quickly, but that's because I only sell to people that have cash right now. Maybe I could generate some additional sales if I'd be a little bit more lax with my credit terms. Right now, I'm not making a moral judgment of whether that's good or bad for your customers, and I'm not even saying that it's good or bad to value, cash sales versus credit sales. But what I am saying is, you can come up with counterfactuals where if nobody ever defaults, think of it that way. If you were, say, a car dealer, do car dealers, for example, do credit checks? Sure. Do car dealers, sell a lot on credit? Absolutely. Do car dealers want for their customers to default and have to go repossess cars? No, it's expensive, it's a pain, they don't like it. But if you're running a car dealership and you never, ever, ever repossess a car, then you're probably being too conservative with your credit terms. That's not an issue that I think we run into much in the real world. In fact, 99% of the problem is people buying cars they cannot afford, but you kind of catch some of the example here. Right? Say a lot of those are based on sales. So when you see CGS in the upper right corner for the margin, if you want to go check your calculation of these different asset management ratios, here's the numbers, again, generated from the common size before you even do these. You could also generate the exact same values by using the full raw dollar amounts on the balance sheets themselves. The top two, inventory turnover and daily sales activity, are just a quick note to folks that they're based on the cost of goods sold rather than the sales. Trying to think of what else to note here. Say again, you're looking at kind of a comparison from one to the next, right? So, hey, daily sales and receivable, daily sales and payable. It's taking you longer to pay some things nowadays, it looks like, overall, more than an extra month. That could be a little bit concerning if you're giving too many vendors too much trouble. So, say it comes with experience too. I mean, calculating the ratios is usually not that hard. You can go verify for yourself that you're getting the calculations quick. With a book or a formula sheet, it's almost hard to do it wrong. But where you really get some use out of these, because other than say a project for me where I ask you to calculate ratios just to do it, you usually don't look at a ratio just to look at it. What's more important and impactful is, again, applying, well, what's good or bad, especially compared to the trend, right? And what kind of information might I glean from seeing my, looking for another example, for seeing my fixed asset turnover ratio, right, go down a good chunk, right, from 100% to 64%, right? Well, if your fixed asset turnover ratio went down, does that mean that my sales, right, are down, or does it just mean that I bought a lot of new? If my sales are way down, that's a problem, right? If my fixed asset turnover went from 1 to 0.68, that would be a problem if my sales went way down and my fixed assets stayed about the same. But maybe my sales stayed about the same or even grew, but I was just overdue to buy a bunch of new fixed assets. I had a lot of old equipment that needed to be replaced. So again, to get the full story beyond some of this stuff, yeah, operationally and even from problems that I have you do for grades and stuff, I allow you to just kind of take these things and run with them. But again, you want an example. You want to be somewhat aware that just because you have a ratio value, you want to be careful that that doesn't always tell you the full story. It's a good shortcut and it tells you a lot sometimes, but not always everything. Profit margins are basically designed to show you how much profit, accounting profit, right, you're squeezing out of your operations here. So in general here, right, most of these higher is better. Right? You see that even on the next slide it says, right, like since you're trying to get a feel for bottom line performance, higher is better. The problem is if you generate higher profits, you must often take on more risk. So even then, while it's true that with profitability ratios, I call these, yeah, higher is better. But even here, you want to be careful, right? What if you're in a situation where, yeah, it's really high, but that's because, right, you did this by generating a lot of sales by growing the size of this business on a lot of credit. And underneath the surface here, if I looked at your debt management ratios and saw like your debt to asset ratio, right, I might have a lot of concern. Which is to say, when you're dealing with ratio analysis, you typically are looking at things more holistically. While you might want to zero in on the question of profitability, you'd probably not do that without also a peek at your debt management ratio to get a feel, is there a chance that there's a lot of risk on here that's helping work towards that sort of thing? Okay. say profit margin interpretation, right? So again, bottom line, higher probably better, but like always, I can almost always come up with some sort of weird counterfactual that challenges that prior. Okay? This to me, like we talked about earlier, profit margin going way up, that looks super encouraging. Profit margin is one of my favorite profitability ratios as like a real, just analyst of a company. It's telling me how much accounting profit I can squeeze out of a certain amount of sales. But if I see it go up 50% in a year, that's gonna raise a flag to me, especially if I've got years and years of 22% and I all of a sudden see 33, I'd want to look into the bottom. And when I see something like an unusual um, indirect, what was that name? Like a special income sort of thing. That really gets my attention that, oh, maybe that increase isn't so much a trend. Maybe it's more of a fluke. Other income, I should say. Right? Right. But the actual computation of these, not bad. Right? Not bad. You're literally, in this case, using um, not all, you're using income statement data for profit margin, right? The rest of them refer um, income statement information to balance sheet information. So the other three, you have yet again a mix of balance sheet and income statement type info. And there again are the calculations if you're looking to just prove to yourself that you got the basic calculations of these things. And I mentioned a bit ago that market value ratios tend to be a funsy one for a true finance person, but they don't just rely on accounting statements, right? Accounting statements have this, everything that you got here, an accountant is very familiar with all those terms, right? They're all right off of financial statements. Notice, by the way, we're talking income statements and balance sheets here. Occasionally, you might use a cash flow statement or equity statement for some little this or that, but this is kind of evidence yet again that cash flow statements are useful to a finance person, especially to show you how the cash changed from one term to the next and get a feel for if there's any red flags there. Equity statements, similar. They show you the detail of how your equity changed from one year to the next, but they are a distant third or tied third as opposed to the importance of the income statement and balance sheet for most financial people. Here, for the first time, you're not just using financial statement info, you're using something else. You're using the price per share. If you're looking, say, go look up a price for a company, you could look up the price today. So while a lot of these ratios would only change every year or every quarter when they're based on purely published financial statement data, you can get a new PE ratio every day because the price of stocks is changing most every minute. Right? Shares outstanding and net income don't change much day to day. Occasionally, shares outstanding changes a little, usually with repurchases of shares. But right, so that one's a little more accounting-ish in that realm. But even the shares outstanding can change. Usually, you'll see the shares outstanding listed at the bottom of an income statement somewhere. You'll see both a diluted number of shares outstanding and a basic number of shares outstanding. They're usually pretty close to each other, but the diluted one is a little bit larger number, and that would take into account any potential like stock option realizations. And so it would take into account, hey, if all these managers cash in their stock options to buy stock, then how many shares would they be outstanding? So that's the difference between diluted and basic, right? But the shares outstanding number here is usually pretty static from time to time. Might change a little bit here and there with a repurchase or something. These other two, though, price to earnings ratio and market to book ratio, they move a lot, right, day to day, because they're based in part on stock price. Now, again, with market ratios, I wouldn't say that there's necessarily a, if you own the stock, you want these sons of a gun high, right? If you have a market ratio, because that means your stock price is high, and that's the whole point of owning stock, is you want the price to go high. Right? But that's presuming you're interested in selling it, of course, and most people would be for enough price, right? So generally higher is better here. For this, but if you change your perspective, you might feel differently. What if you don't own any stock right now? What if you're just interested in buying some? What if you have your first job and you're looking to start buying into the stock market with your 401k contributions? Then you wouldn't be so excited about the PE ratio being high. That would denote that stocks are expensive, right? They charge or they sell for a relatively high price compared to the accounting profit they generate. Right? Which is again great if you already own them and can sell them and take the cash today. But if you're looking to buy in, that's kind of discouraging because it means that, oh, these things are expensive if I'm looking to generate a return on them. One weird thing is that market to book ratio is also sometimes called price to book. Right? So you see market to book, right? But you notice on the slide, right, that it's the price per share. It's the same, right? It's the same calculation. So why would market get right, be based on the price? Well, it's the market price, right? Or sometimes the PB ratio, right? Whereas the price to earnings is really famous. It's called the PE ratio. Right? It's so famous you'll even hear about it like in commercials and stuff sometimes that are pitching some stock, information. This is really famous and common because it compares what kind of stock price something sells for relative to the accounting profit it generates. With again the idea being higher is better if you already own it because it means the price is high. But if you're looking to buy in, it would be sort of troubling. And again, I say it's weird that the word price here and the word market here actually both mean the exact same thing. They mean put in the current stock price in the numerator. But say I always thought it was weird that you'd see the word market, like market to book, abbreviated with the letter P. That's just one of those things. Right? So what's that tell us? Well, since market ratios include the current stock price, they give you some feel for what the market or the people in the market at large think about the company. Right? A high PE ratio is typically a sign of some kind of faith, right? That hey, they're not generating this much earnings now, but they will later. Right? If you have a relatively high PE ratio, it's kind of taking on faith, right? That you're going to have some big quarters, years, etc. in the future. Right? Either that or just people are just willing to pay a lot for the stock right now, and sometimes the PE ratio getting really high is kind of a tell that whoops, this thing is maybe expensive. Maybe I should avoid that stock. Say not always. There's different investment experts that feel differently about that sort of thing, but you get the idea. And again, as an investor in particular, that sort of thing is really useful when you can compare it to other firms, right? So if you have, for example, a peer comparison where Conoco, the oil company, Conoco sells for a PE ratio of 20 and Exxon shares for a PE ratio of 13, that would make a lot of people a little leery of the Conoco, right? Why are you willing to pay $20 for every dollar of earnings that Conoco makes when you could pay just $13 of earnings for Exxon shares? Right? Seeking out companies with low PE ratios is called value investing, by the way. So when you hear the word value investing, that means trying to get a bargain, trying to get something cheap. Well, how do you determine cheap when it comes to stock price? The most common way of all to do it is via this PE ratio. Right? It's cheap, the numerator is low relative to the accounting profit that it generates, usually again adjusted for something like industry. So you get a lot of investing that is done by trying to look for relatively low PE ratios, sort of thing. And what is low? Well, it depends on your peers. Sometimes it will value, excuse me, what counts as low in 1 year might seem very high 5 years later. So all the more reason to have kind of that eye on the trend when we're talking about ratio analysis. You have to have a stock price to base this thing out on, so I just made up a couple here at the bottom on slide 32 if you're looking to, right, go check your earnings per share, right? That's your net income divided, or EPS, so your net earning per share, your net income, right, divided by your shares outstanding. Right? So you need to go check your right, info there. $5.15 for earnings per share. Well, if that's your earnings per share, right, and your price is 64, right, Well, then 6483 divided by 515 is 12.58. That's your PE ratio, your price in the numerator, 64, your earnings in the denominator. When you see the PE ratio go up a lot, or go down a lot, think, well, maybe that would be a sign that the shares are getting cheaper. And you say, well, the shares are getting cheaper, but the earnings have also gone way, way up. Okay. So in this case, what happened is the price might have moved some. It did. It went up about 15, 18% from 54 to 64, 55 to 65. Right. The price went up some, but the earnings went up even more. The earnings went up about 70%, 80%, that kind of thing, right? So the price only went up 20, the earnings went up 80. When you put those things together, you see the PE ratio, even though your earnings improved, even though your stock price improved, right? Your earnings improved even faster so that the PE ratio went down, right? The earnings is in the denominator, the price in the numerator, that's what makes it a PE ratio. Right? One kind of final thing that we talk about a lot in here is ROE and the DuPont equation. So ROE is defined as your return on equity. Right? And I think if we do, I need to be a little bit careful here. So I think I might have skipped through that fast. So let's be really obvious with each other. Right, your ROE is your return on equity, right? That's your net income divided by your total equity. This is a measure of profitability. So if I had to go back and put it under one of those categories from above, it's pretty obvious which one it would be in, right? The same as profit margin or right? Those good things right here. Right? Oh, I did. I see. I skipped by it. I just didn't say anything at the time. I knew it was coming to it here at the end, but I should have said something. It's kind of a measure of how much accounting profit can you squeeze out of the base of how much equity we have. Now, in general, you would think more ROE, the better, right? So here comes the big speech and a big concept thing for class, right? So ROE is higher better? You can probably guess from my tone. Maybe. Be careful. Look at ROE. It's your net income. If your ROE goes up because your net income goes up, hunky-dory. That's good news, right? It means you have the same kind of size equity, accounting equity in your firm, and you're just generating a lot more profit. So sure, if that's the story, right, under the hood, then ROE going higher is indeed better. What if that ain't the whole story, though? What if you're in a position where my net income stayed the same from one year to the next, but you know what I did? I cut my equity in half, right? Maybe I borrowed some extra money and repurchased some shares. I retired some stock, right? Well, what happens to the ROE if your equity gets cut in half? Your ROE goes up 2 times, it doubles, right? A fraction can go up because the numerator increases, but it can also go up because the denominator decreases. So you want to be really careful about interpreting ROE. Right? If ROE goes up, is that because we've had more profit, or is that because we've restructured the firm? Right? And it's particularly dangerous here because if you have less equity in the company, that probably means you're riskier. Yes, you have more debt to service and stuff like that, relatively speaking. So one tool designed to kind of hash this issue out is the DuPont identity or DuPont equation. Right? So we'll take here, for example, we'll talk about your ROE. Right? Now, most people, I'm even going to flip down a couple slides for a demonstration. Your ROE in year 1 was 27.52%. Your ROE in year 2 is 38.09%. Right? All right. All right, well, let's take a look at, and it's probably good to do one of these calculations anyway. Right, your total assets, remember, were 72.921. That's the actual dollar amounts. So that's the basis for all of your common form financials. Well, what were your what was your equity? Your equity here in year two was 42.52%. All right, so what's 42.52% of 72,921,000? Well, the answer is 31 million, about. All right, so that's how much equity you have. Right? What was your ROE here, right? Well, it's something over your total equity. Your equity was 31 million, right? You need your net income. And since you're dealing now with a mix, and ROE mixes income statement and balance sheet information, you need to use dollars here. You can't just use the common form because you don't, your sales and your total assets are not exactly the same, right? Your sales is 35 million, your total assets was 72. So since you're using two different bases by which to come up with those values, when you go to get your ROE, you need a dollar and dollar comparison. So this time your net income is 11,809,000. Right, so 11,809,000. Right, and then when I do that quotient, right, I'm just going to do it roughly. If I do 11.81 divided by 31, I'm getting 38.1%. So 0.381 or 38.1%. All right, well, what does that mean? Well, that's my ROE. It's my net income, yes, over my total equity. There it is at the bottom, 38.1. Okay. Well, where did that come from? And how did it get there, especially compared to the year before? It was 2752. Now it's up to 3809. Okay. All right. Here's the DuPont equation or DuPont identity. It's all here for you on the slide. It's your ROE, right? But it's written in a different way. It's written in a different way. You know, the normal thing to do, and I'm the same way, when you get learning some math is people like to cancel when they're doing fractions, right? So if you see somebody write out the expression, hey, here's 2/3 times 3/4 times 4/5, right? What's everyone want to do? They want to go cancel the 3's and cancel the 4's and get 2/5 or 40%, yes? The DuPont equation works in reverse. It starts with a number like 2/5 or 38% or 40% if it's 2/5. And it says, no. I want more detail, not less. I'm not worried about clutter. I want detail. So what it does is it takes your net income over total equity. See, that's the first numerator and the last denominator. And what it does, it actually expresses intentionally ROE as a product of three fractions: the profit margin, the total asset turnover, and the equity multiplier. Now, see, you could cancel the sales and you could cancel the total assets, but the whole point is you don't want to do that. You'd actually rather see the ROE expressed out as a product of these three values. Because when you do, you get a lot more information about, well, why does the ROE have a value of, say, 38%? Right? By the way, say your ROA, you can kind of do a similar thing here too, if you really wanted to. Right? And of course, you can take the bridge in between and say your ROE is also known as your ROE times your equity multiplier. I don't really ever think of it that way on the bottom, but it's true and kind of handy. Here's what I'm saying, right? You think here right away that, right, ROE is 38% and that's up from 28%. And you think, well, that's a good thing, right? And it is a good thing, right? In this case, it's a good thing, right? it's mostly driven here by how much your profitability margin went up. Now, again, you got to chase the rabbit down the hole and think, well, why did my profitability margin go up so much? Is it because of a one-time, like, indirect earnings kind of thing? Is it going to repeat, on my financial statements before I look ahead and get a feel for this sort of thing? But, right. That's largely the driver here is the profit margin. There's also a little bit of the equity multiplier effect. The equity multiplier effect just tells you relatively how much debt you have. The bigger the equity multiplier, right, the more debt you have. I know it sounds stupid that it works that way and backwards, but that's just because of how it's the quotient, right? It's the assets over the equity. So the less the equity, the higher the quotient, right? This tells me that year 2 has a little more risk than year 1. The equity multiplier is higher, but it's not a huge amount higher, right? It's not a huge amount higher. It went from 2 to 2.35. So that's part of the story, right? If it were me describing the story, my story would be, yeah, my ROE is up impressively, right? It went up quite a bit. Some of that is due to invariably good news, increased profit margin, although we need more information in this case about whether that's sustainable. It was based on kind of a weird entry that might be temporary. That's part of the story. And another part of the story is the equity multiplier that says I'm effectively have more debt. And so maybe that's part of the reason that I'm able to squeeze more net income out of equity is because there's less equity from which to squeeze, relatively speaking. Right? And your total asset turnover ratio in the middle is sort of in between. Right? It's mostly good news to see that value go up. Remember we talked about that back in asset management, but it's a little more ambiguous sort of thing. To me, the biggest thing you really want to focus on hard when you're doing DuPont analysis, especially when you compare two companies to each other like you tend to do or to yourself over time, really be on guard for the equity multiplier. If the equity multiplier goes way up and that drives the ROE increase, well, then the story is much more dicey. If you get an ROE increase with the equity multiplier staying the same, that's more genuine good news from which to celebrate. Right? But it is weird at first for people to kind of go out of their way to cancel or not cancel. Right? So here you go. Right? That's kind of funny. Shows you an example, right? A book-based example of where, for example, a 28% ROE really comes from. Well, it comes from your ROA times your equity multiplier, which again isn't one I always thought that much about, but it is true. Right? Well, where's your ROA come from? Right? Well, your equity multiplier of 4 is just telling you that you have like 80% debt and 20% equity in the company. That's a pretty heavy debt base, but it is what it is there. Well, here's your ROA. It comes from your profit margin and your total asset turnover. Right? Where's your profit margin come from? Well, your net income relative to your sales. Right? Well, where do those dollars? Now you can get down to the dollar amounts of those things. How about total asset turnover? Well, depends on your sales relative to your total assets. How much of those are fixed plus current? So if you can dig deeper and deeper, but that goes back to where we started with this whole presentation, which is that, the goal of ratio analysis and financial statement analysis in large part is to save yourself time and effort, to try to take shortcuts, to learn some things quickly, right? If you're going to go back to all of the basic financials, if you're going to go back to all this purple data, well, that can be a pain, right? So that's the whole point of this sort of thing, and that's why I like you to be aware more than anything else. It's all about trade-offs. You can gain a lot of information and utility quickly by doing a DuPont type look, but it also costs you a lot more work to get to the bottom of things, right? If you take a basic ratio type of approach, you're kind of cutting corners, not in a negative way, but you're getting shortcuts towards your information. Right? Sometimes it's absolutely essential to do that for any kind of efficiency, but it's not the same as looking into the detail and the management discussion thereof that you see from the purple. Right? And so again, that's the ROE. Are you really taking into account the risk that might come with more debt, for example? kind of thing. So if your whole goal was to get ROE up, one way to do it would be to take on more debt to repurchase stock, and that'd probably be dangerous in many, many cases. Right? There's other things that can make ratio analysis. Say again, the biggest one of all is you're taking a shortcut. Right? That's the biggest one of all to be cognizant of. I'm trying to get information quickly, and there's a trade-off to that. You can also get things where sometimes if you're looking at, say, quarterlies instead of annuals, you get some things out of whack if you're seasonal. You might be good in some areas and worse in others. One called window dressing, talk about, is companies know that people do ratio analysis. So they might try to put their finger on the scale to get the ratio analysis, to get the ratios to look good. And some parts of some ratios are manipulable. And so that's something to keep in mind too. So window dressing is when the company goes out of their way to report things in such a way that key ratios look good to analysts so that they will be bullish on a firm, right? But it doesn't change the bottom line of the operations underneath. Right? Not every company does every accounting thing the same way too, so that can make comparison challenging, or sometimes a company changes in-house accounting practices over time. Right? So that can be a challenge. Usually you're not great at everything or bad at everything. So if the bottom line is, as an investor, if you're doing this as an in-house analyst, it gives you something to focus on. Oh, my debt management is an issue, right? But if you're looking at this as a potential investment, oh, I'm looking to buy stock. Who should I buy? Well, I'm going to look for a good company that's maybe cheaply priced, low PE ratio sort of thing. Well, usually it's hard to say what's good or bad. It's very rare you find a company where you calculate numbers and, yep, all the high ones are in the places that we like high, and all the low ones are in places that we look low, and it's really good to buy. So if you're trying to do ratio analysis as an investor, you can be left sort of paralysis with analysis sort of things. Some other things to keep in mind: not everything about company analysis comes from ratios. There's a lot of things that you cannot quantify at all. So when we say qualitative factors, right, that's in contrast to quantitative. Right? So sure, qualitative is one side. Whoops. Versus quantitative on the other. And you can't always put a number on things like, hey, some companies are totally reliant on one vendor for a certain key element to the product that they absolutely need. What happens if the vendor goes away? Or what happens if you have lots of customers versus you only have one or two wholesalers that you sell to? What if I'm in an industry that gets a lot of regulation, where politicians might want to make an example out of me, regulate me to death, right? Versus, everybody's fine with my, fruit stand. They don't care about Dole pineapple sort of thing. Right? Maybe I'm in a highly competitive industry, or one that looks to get much more competitive soon. And so you might have risks and or opportunities that are not always quantifiable. So why ratio analysis is part of the puzzle and a useful mathematical shortcut, even if it is a mathematical shortcut, doesn't mean it's telling you all there is to say. All right, that's a lot. I have some more presentation stuff about how to do some problems and think about attacking certain problems that I want to talk about, but in terms of financial statement analysis discussion, let's cut that there.